Now, will China crack down on credit or not? Bets that it won't has propelled Shanghai stocks out of a bear market. But now China Construction Bank's assessment of the banking system may suggest that tightening is ahead. Francis Yun has more on the story and checks in on China's stocks trading here in Hong Kong and Shanghai. Francis.
Hey there, Susan. Now, the chairman of China Construction Bank says a flood of cash in the country's banking system is swelling asset prices at a time when there are, quote, uncertainties in the economy. Now, right now, the Shanghai Composite Index is up more than 60% this year, and a real estate industry report showed that China outpaced the U.S. and U.K. combined in commercial property sales in the first half of the year. And that's highlighting concern that the Chinese government may need to control speculation instead of tolerating it in the name of economic growth.
I think they're very legitimate concerns to be worried that governments are now pushing on the end of a string and that however much money governments put into the system, they'll get precious little reward for it. But I'm afraid one of the side effects of that, of course, is that we're seeing this money spill out into financial markets and drive prices higher.
And Chinese banks had handed out a record $1.1 trillion of new loans in the first half to fuel the nation's multi-billion-dollar efforts to prop up the economy. But jittery investors bet that rising asset prices would propel the government to crack down on credit and prompting a sell-off, which drove stocks into a bear market last week. Now, China's already begun raising the stakes on banks. The country's banking watchdog required lenders to raise reserves and give loans for projects focusing on to support the real economy. But CCB is also being more careful, and President Zhang Jianguo told Bloomberg that he'll cut the amount of new loans by 70% in the second half of this year. Susan?
Okay, Francis Yun in our Hong Kong newsroom. Now, our next guest also says that stocks have run up too much and maybe it's time to hold more cash. Vietnam Warren is Global Chief Investment Officer at Bank Julius Baer, where he helps to oversee more than $250 billion worth in assets. And he joins us this morning from Singapore. Good to see you once again, Anantha. So let's talk about this run-up in stocks. As you heard there, Hugh Young saying that all this liquidity from stimulus programs really pushing up financial and stock assets. You probably think the same.
Yes, Susan. I mean, I think in March we were one of the many people who said markets were quite oversold, and we did tell our investors to add beta to their portfolio. So there is no permanent label of a bull or a bear. Ultimately, it is the prices that determine the investment stance that we take. And certainly since the end of May, I think the market has already priced in a lot of good news, and therefore whatever rally we have seen since the middle of July until now is definitely extending the fundamentals beyond justified levels. So particularly so in Asia and also definitely in the US as well. Prices have run up way too ahead of the likely improvement in the underlying economies.
Now, Anantha, I just want to specifically talk about China because you heard Francis Yun there quoting China Construction Bank's chairman talking about possible bubble asset levels. What do you think? In fact, you're actually recommending people short Chinese stocks right now via an ETF.
Yeah, I mean, it's not very easy for people to short China stocks because there aren't option strategies available. But if wherever clients do have this option through inverse ETFs, they could take a bet because right now the prices are very, very highly extended. And therefore it is possible to use these inverse ETFs at extreme levels such as this in the market to short, where the downside is limited for clients because after all you are buying a long position in an inverse ETF. That's a better way to short markets these days.
Anantha, is there a bubble on the mainland?
Yes, indeed. I think there is definitely a bubble in the stock market as well as in the property market, because basically the next year's growth rates have been pushed up by consensus to about 9-10%, which is completely unjustified because the underlying economic story is still one of export dependence, and US and the Eurozone economies are likely to sputter and disappoint in the course of 2010, and therefore China has very few domestic economy bullets to fire next year, having used up the bulk of bank lending and fiscal policy this year. So if anything, growth is likely to be lower than this year other than higher than this year, and therefore I think the stock market discounting such acceleration in growth in 2010 appears unjustified to us.
Yeah, well, Anantha, it seems like the Chinese stock market seems to move in tandem with speculation of will they or won't they tighten lending right now on the mainland. But let's say you were the Chinese government. I mean, what can you do? What should the government do to reduce this this bubble state that we're in and not cause panic, leading to a possible stock market crash?
No, well, I think one of the things they can do is to basically make sure that the cost of capital is priced properly in the country, and that is what will enable stock markets to be much more realistically priced, because most of the profits are being made at the expense of depositors who are earning abysmal rates of interest. So if the banking system prices capital properly and rewards depositors properly, investors also will have other options than to simply pile on to stock and property markets for investment returns. And that will basically smoothen out the fluctuations in the stock market from booms to bust to boom on an annual basis.
Now, what do you need to see before you might even consider going back and picking up more Chinese shares?
Well, always it's a question of lower prices. First of all, I mean, if prices are attractive, regardless of fundamentals, and if we believe that the prices have discounted dreadful news, then I think it's a good time to buy. So in that sense, we need to see lower prices.
Well, what about the Chinese shares trading in Singapore? Some would say on a valuation basis, they're trading much cheaper than their counterparts here in Hong Kong and also on the mainland.
Yeah, that is always touted as a possible way of rotating into same market, but in different scripts, trading at lower prices for different reasons. I'm not a great votary or enthusiastic champion of such approaches, because eventually, when the price is correct, they will correct everywhere. Probably they will correct less here because they didn't go up so much. But that's a matter of relative trading, which is more easily done by fund managers and professional investors rather than by individual clients.
Okay, so what is the take-home message here, Anantha? It's to be safe rather than sorry, and Asian stocks have run up too much too quickly, so it's time to get more into cash?
That's right, Susan. You put it very well. It is better to be safe than sorry right now. I think since March, Asian markets have run up too much. Asian central banks are also reluctant to rein in the money supply and also allow currencies to appreciate. Asian currencies have been lagging emerging market currencies this year. So I think we are kind of repeating the same situation that prevailed in 06 and 07 that gave rise to synchronized global bubbles, especially now that potential GDP growth is much lower everywhere. So I think investors should be raising cash, cutting down on risky exposures, and concentrate on maybe agricultural commodities, precious metal as a long-term diversification and risk hedge play at this stage.
And how much cash should one hold? I see 32% of your portfolio is in cash. It should be higher for most individuals, or?
Well, in our advisory portfolio, that is the cash level we are recommending. Of course, it also includes inverse ETF positions that I have put in there for S&P 500 and China stocks. So if some clients are not comfortable doing these inverse ETFs, then their cash levels ought to be higher. Emerging market bonds are definitely, better yield, but then certainly in the short run, spreads have compressed a lot. But investors are looking for yield. They can still hold on to them, but accept short-term price volatility. I think in general, right now, investors should basically be patient and wait for better entry points instead of thinking that I missed the rally, I have to jump in right now. And that is why they end up losing the most usually.
Okay.